A lot of our content so far has been focused on how you can use your money to grow your wealth. But what happens if you're already saddled with massive amounts of debt? That's what we're going to talk about in this video. And the fastest way to get out of debt is a concept called velocity banking. Now, this strategy requires you to still be able to get some shred of credit because it really utilizes two things: some kind of line of credit, whether it's a HELOC or a personal line of credit, and credit cards. Now, if you can't get approved for some kind of line of credit, you still have the ability to look to a family member or a friend who might offer you a loan in order to get out of debt. And I've done this personally for people. I've loaned money to help them get out of debt. So this is something that is viable if you're willing to ask a friend or a family member. It might sound crazy to you to use credit cards or lines of credit to get out of credit card debt, but it really does make sense. So if you're paying 15, 20, or 30% in credit card interest, getting out of that as fast as possible can be done with credit. Now, the first thing you need to do is get a 0% APR intro offer credit card. I'll leave a link in the description for my favorite credit card that has no fee and has zero interest intro offers. Now, one thing you want to watch out for is balance transfer fees. So sometimes if you try to do something like a balance transfer, they'll charge you 3% off the top just to transfer that balance. So you can use balance transfers, but beware of that transfer fee. Once you have that credit card, ideally with 12 to 18 months of zero interest, you start putting all of the expenses possible onto that credit card. And ideally, the expenses that you put on that card, you don't pay an extra fee for putting that on there. So some examples where you might pay an extra fee are something like a gas bill or an electric bill. But if you put all of your grocery expenses on the card, then you're not going to be paying extra fees to the grocery store. Depending on your provider, you might be able to put something like your electric bill or gas on your credit card, but make sure that you're not paying an extra fee to do that. Depending on how much high interest debt you have, you may not be able to use just the zero interest credit card to offset that interest. And so this is where a personal line of credit or a HELOC comes into play. You can use the HELOC or personal line of credit to immediately offset a higher interest rate. So once you've used the HELOC or the personal line of credit to offset that high interest credit card debt, then every time your income comes in, you should be immediately applying it to that HELOC. But you can still then use the HELOC to draw from it if you do need to use it for expenses. This means that every single dollar coming in is offsetting interest immediately. So at this point, you should be putting all of your living expenses that you can on that zero interest credit card and all the other expenses on your HELOC. And immediately when your paycheck comes in, you should be paying it towards your HELOC, which then frees up some space to use for living expenses and paying bills. You should also keep in mind that once you've paid off your interest-bearing credit cards entirely, you now have the ability to use that credit card to put expenses on it. And if you pay that statement balance off every single month, then you will not accrue interest on that credit card. Throughout this process, you should be targeting the highest interest balances first and paying them off as fast as possible, using either zero interest or lower interest to offset the interest on the higher interest balances. So within a few months, you should have eliminated all of your interest-bearing credit card debt, and the only interest that you're paying should be to that HELOC or personal line of credit, and maybe your mortgage and other car payments and things of that nature. And then you put your focus on paying down that HELOC or personal line of credit balance. Once you've paid off your line of credit, you can start to put your focus onto lower interest-bearing things. So you can continue to put your expenses on either your zero interest or your other credit cards as long as you're paying off the statement balance, and then use the extra funds to offset the interest on your car payment loan balance. So if you're choosing between a student loan and another balance that has equivalent interest, it might be better to pay off the student loan first, since there are special considerations around bankruptcy and student loans. So once you've paid off your car and maybe your only debt left is a mortgage, it now becomes a consideration as to whether or not you should pay that off at all. I have a full video breakdown as to why I will likely never pay off my mortgage. Check it out here. Basically, I can get a guaranteed return that's higher than me paying off my mortgage. Once you've eliminated all of your high interest debt and you're ready to start building up your credit score, you're going to want to keep each individual line of credit below 30% utilization. So for example, if you have a $10,000 credit limit on a credit card, you should stay under $3,000 on that balance. Even if it's a zero interest credit card, stay under $3,000 for the long term. I hope this video was informative. If it was, consider dropping a like and let us know your thoughts in the comments below. We regularly put out content on unconventional wealth growth strategies. Subscribe to learn the strategies the millionaires and billionaires use to build and maintain generational wealth. Thanks for watching. I'll catch you in the next one.